Hi, I'm Daniel Dixon with FreeAccountingSchool.com, and today we're going to answer the following questions. How do you record the sale of a product using double entry accounting? What is sales revenue? What is a sales revenue account? And what is a cost of goods sold account? And we're going to answer all these questions by going over an example. Okay, so let's pretend you have a store that sells t-shirts, and you have a very simple business model. You simply buy t-shirts from a wholesaler for $3 a piece, and then you take them to your store and you sell them for $5 a piece to your customers. Okay, so then let's pretend a guy comes in and he buys a t-shirt from you for $5 with cash. And remember, that t-shirt had cost you $3 before from your wholesaler. And then after the sale, you take the $5 and you put it into a safe in your store. So how would you record the journal entries for this purchase in your accounting system? Well, first off, let me tell you that this journal entry has 4 parts to it, which means you're going to make entries into 4 different accounts. This is known as a 4-sided journal entry. But you're going to learn to love 4-sided journal entries. I know you will. Okay, so let's do the first part. Okay, so the first thing you're going to do is go to an account called Cash in Safe. Now, what type of account is Cash in Safe? Well, if you said it's an asset account, you would be correct. And this particular asset account is used to keep track of the money that goes in and out of your safe in your store, right? And to show an increase in an asset account, you do a debit. So that's what we're going to do. We're going to record a debit of $5 to show that we now have $5 in our safe that we didn't have before. And you'll remember from previous lessons that in a real accounting system, you're also going to put the date that this transaction took place, okay? So that was the first part of the 4-sided journal entry, which is pretty easy, right? So for the second part, we're going to go to an account called Sales Revenue. Okay, and before we make the entry into the Sales Revenue account, let's go over what revenue is in a business and what sales revenue is, and how a sales revenue account is used in a business. Okay, so what is revenue? Well, revenue is simply income that's received by a business. You probably already knew that. Okay, so what is sales revenue? Well, sales revenue is income received by a business for the sale of goods or services. Now, most revenue that comes into a business is sales revenue, but there's also money that comes into a business from investments, and that would be called investment revenue, or maybe you get a refund from a vendor or something like that, and that would be a different kind of revenue. But most revenue you're talking about in a business is sales revenue. Okay, so what are sales revenue accounts used for in an accounting system? Well, a sales revenue account is where you record an explanation of why money or the promise of money came into a business when you have a sale, okay? So it's not a record of the money itself, it's a record of the explanation of why you got the money or the promise of money. Okay, so before we go to back to the actual journal entry, keep going on the journal entry, we need to answer one more question. What type of account is sales revenue? Maybe you have some guesses because of some lessons we did in the past. So if you said it's an asset account, you're wrong. I'm sorry. If you said it's a liability account, I'm sorry again because you're wrong again. But if you said owner's equity account, you are correct. And if you'll remember, sales revenue is actually in a subcategory of owner's equity. So there's the owner's equity category of accounts, and then there are subcategories underneath that. And revenue accounts are one of those subcategories, and sales revenue is definitely in the revenue category, right? Okay, so let's keep going on the journal entry that we were making. Okay, so we're going to go to the sales revenue account, which you now know is an owner's equity type of account. And you'll remember from my previous lessons that to show an increase to an owner's equity account, you do a credit. So we're going to make a credit of $5 to sales revenue. So right over here. So this entry to sales revenue account is doing 2 things, okay? Firstly, it's explaining why we got this $5 over here in the safe, okay? And the reason why is because we had a sale, okay? And secondly, this entry to the sales revenue account is telling us that for this part of the transaction, the owner's equity is going up by $5, or the owner's wealth is going up by $5, just for this part of the transaction. You'll see what I'm talking about later, okay? So that was the second of the 4 parts of this transaction, okay? So you're halfway done. Okay, so the next thing you're going to do is go to an account called inventory, and you've seen the inventory account before, I'm sure, in our previous lessons. The inventory account's where you record the value of the inventory that you have in your store. So for our example, it's where you record all the value of all the t-shirts that you have in your store. So what kind of account is inventory? Well, if you said asset account, you are correct. And for asset accounts, to show an increase, you're going to do a debit, and to show a decrease, which is what we have here, you're going to do a credit. So we do a credit for $3, which is showing that we have one less t-shirt that was worth $3. So our inventory is going down by $3. Okay? So that makes sense, and that was the third part of our 4-sided journal entry. Okay? So for the fourth and final part, we're going to go to one last account called cost of goods sold. And before we make the entry into cost of goods sold, let's talk about what cost of goods sold account is used for in an accounting system. Okay, so the cost of goods sold account is where we record an explanation of why you have less inventory when a sale is made. Okay, so you're probably starting to see a pattern here. With double entry accounting, you don't just record that an asset went up or went down, you record why the asset went up or went down, and you record, and at the same time when you give this explanation, you're also recording what happened to the owner's equity. Okay, so what type of account is cost of goods sold? Well, it's an owner's equity type of account, and it's actually in the subcategory called expenses. So again, owner's equity is one of the main categories of accounts, of accounting accounts, and there's subcategories underneath that account or that category, and one of those is expense accounts. And cost of goods sold is an expense account. Okay, so let's continue on with the last part of our 4-sided journal entry, okay? So we go to the cost of goods sold account and we make a debit entry in the amount of $3. Now, why did we do a debit here? Well, because for an owner's equity / expense account, a debit tells us that an expense is going up and that the owner's equity is going down. Okay? So really this entry to cost of goods sold is telling us those two things. Firstly, it's telling us why this inventory went down by $3, and the answer is because some goods were sold, okay? And secondly, it's telling us that for this part of the transaction, owner's equity or owner's wealth is going down by $3 because you don't have that t-shirt anymore. Okay, so that's all 4 sides of the 4-sided journal entry. That was the whole journal entry for the sale of a product in a double entry accounting system. So let's review what we did, okay? So first we did a debit to the cash and safe account of $5, and that was to show that our cash increased by $5 in our safe. Then we did a credit to the sales revenue account for $5, which explained why the cash in safe account went up by $5, and it also explained that for this part of the transaction, the owner's equity went up by $5. Then we did a credit to the inventory account for $3, which showed that the inventory went down by $3. Then we did a debit to the cost of goods sold account, which explained why the inventory went down by $3. And it also told us that for this part of the transaction, that the owner's equity went down by $3. Okay, so let's quickly look at this transaction from the point of view of the accounting equation, which you'll remember is the value of the asset accounts equals the combined value of the liability and owner's equity accounts. Okay, so let's look at what happened. Okay, so first off, the assets went up by $5 when we did the debit to cash in safe. Then the owner's equity went up by $5 when we did the credit to sales revenue for $5. Then we did the assets went down by $3 when we did the credit to inventory for $3, and then our owner's equity went down by $3 as well when we did the debit to cost of goods sold. Okay, so these two combined, the assets went up by $2 on this side, and the owner's equity went up by $2 on this side. So the balance, or the equation, stayed in balance. And this is also, again, showing that the net effect of the transaction was that the owners became wealthier by $2. Okay? So that was it. Thanks for joining me today. If you like my videos, give me a thumbs up please on YouTube, or maybe become a subscriber to my YouTube channel. Also, if you want to check out more videos that are free about accounting, go to freeaccountingschool.com.